Welcome to LA Roundtable, a full hour of in-depth discussion about one major issue affecting Los Angeles and Southern California. I'm Dave Bryan, political reporter at KCAL Channel 9 and the moderator of the Roundtable on LA Cityview 35. There's a long list of serious problems facing all of us who live here in Southern California. We have to address these problems and come up with some solutions if we expect to maintain our quality of life. Our topic for this roundtable is housing. It seems like a simple enough subject. Everyone needs a place to live, whether they rent an apartment or buy a home or condo. But as we all know here in Southern California, there's nothing easy about finding and affording a decent place to live. Joining our roundtable on housing are experts and activists from across Southern California. Tom Swanson is a senior manager for mortgage lending with Wells Fargo Bank, one of the largest housing lenders in the country. Joseph Meilander is an affordable housing advocate and blogger. His opinions were recently published in a week-long series called Dust Up in the Los Angeles Times. Con Howe was the longtime planning director for the city of Los Angeles. Recently, he's been head of the Center for Balanced Development in the West, and he's about to join a new organization to promote workforce housing. And Scott Choppin is CEO of the Urban Pacific Group, which has developed many kinds of housing throughout the western United States. Well, you know, the newspaper headlines recently pretty much tell the story. You don't have to go too far to find out what's going on in the housing market in Southern California. State home sales plummet, foreclosure pace nears decade high, home sales plunge 8.4% in March. Obviously, gentlemen, there's some turmoil now, to put it mildly, in the housing market in Southern California, with credit being tightened up, foreclosures are up, default notices, sales are down. What's going on? I want to get everybody's assessment before, as we get started here. Jump right in, somebody.
Well, I'll take a first shot at it. From the developer's standpoint, we're certainly seeing a general softening in sales absorption rates, a little bit on pricing, but not as bad as we might have expected given the news you might read here and there. So we're generally continuing to maintain a good sales pacing, a little bit of softening, but feel fairly strongly that it's going to continue at a kind of a neutral pace, but still do well.
Okay.
Yeah, if the pace slackens, it doesn't mean that prices are dropping too, and they aren't dropping too much. I put a lot of stock in the Anderson forecast, and they came out last week with another real estate forecast, and they weren't too worried, so I'm not too worried.
And the Urban Land Institute follows markets throughout the country, and actually Los Angeles and this whole region has such growth numbers in terms of jobs that I think whatever the downturn in housing is going to still have a recovery because of the population and job growth.
And I agree. We've seen some sales activity drop, but I think when you look long term, this is still a growing area, and long term, I think, is very bullish for the housing market.
Let me read you some statistics that have come out recently in some of these reports. Home sales in California fell nearly 21% in March compared to a year ago in response to rising mortgage rates and tighter lending standards, according to the California Association of Realtors. In LA, the report said sales fell 4.5% from a year ago, but plunged 55% from February. Data Quick Information System says nearly 900 Californians a week are losing their homes because they can't afford to pay the mortgage. That's up from 100 a week a year ago, an increase of 800%. I mean, those numbers sound pretty scary, a little scarier than the way you guys are painting things.
Yeah,
are you being optimistic, or is this giving people a distorted picture?
Well, a lot of those foreclosures, of course, were on subprime loans to begin with, which the bank didn't have a lot of optimism even going in. That's why they were subprime. So that accounts.
Subprime meaning what for people who are?
Subprime meaning all these categories of like the low doc loans. You've probably heard them called the liar loans.
The exotic loans are also referred to.
Loans with high interest, loans qualifying people that probably shouldn't have been qualified. I even heard one recently, the ninja loan.
The ninja loan?
Yeah,
what exactly is that?
That's the no income, no job loan.
I see. I assume that's a joke, right?
It is a joke. But, you know, there wasn't a lot of optimism, I think, with these loans to have a really high performing rate to begin with. And those are the foreclosures that I think we're seeing more of now.
Well, go ahead.
what we've seen as a lender is we went through a 3 to 5 year period of a lot of refinance activity, and there was huge capacities built by lenders to support that, refinancing of loans as rates dropped. As that went away, we seemed to find lenders that wanted to keep their operation going, and what they seemed to do was take on more and more risk as a way to keep their operations going. And of course, with housing values going up, it's not the time that you see a lot of foreclosures, but as it stalled out, now those subprime lenders and some of the loans that Joseph talked about, the ones that were not originated what we would view in a responsible way, that, yeah, they are, in fact, foreclosing.
It's probably useful to look at the last time this region had a serious housing recession, and it was early 90s. And see, that was really accompanied by serious job losses. I mean, partly it was a national recession, but there were, with the aerospace industry and other cutbacks in this region, there was serious job loss. And then I think, I don't remember the details of it, Wells Fargo remembers, but the homes at the higher end were losing 25%, sometimes 30% of their value. And that's not happening now. There's foreclosures are up, but the prices have not come down, although they've moderated.
And some experts say that they're going to have to come down to bring the market back in balance, that because prices have not come down, that's why we're seeing the sales plunging and the supply of houses on the market increasing to a point where something's got to give.
Well, if people have an expectation of, after a run-up, they have an expectation of what their home is worth, and they just don't want to lose that. Mm-hmm. But you're right, it is going to moderate prices, and in some ways that's not a bad thing at all. First of all, the seller typically has had a great run-up, and so it's not like they're losing money. They're just not getting the gain they hoped, and for the new buyer, actually more people will be able to, with a softening in prices, more people will be able to buy.
I think part of the concern, you mentioned job losses, but in the 1990 situation, but part of the concern, I think, is that housing now makes up such an important cornerstone of the California economy in particular, that if that portion of our economy stalls out, let's say for a while, that it could sort of have repercussions for the entire economy. Do you see that happening?
What we're seeing, if you read the industry magazines as well, construction rates on residential have certainly slowed down, given rates of sales going down. We're seeing a distinct shift over to construction activities in the commercial. Industrial markets have always been doing well. We just don't talk about them much. So we're seeing a distinct shift, and you're reading the stats and seeing companies shifting over now, becoming more commercially oriented. And that's not today's subject, but certainly we don't see a huge loss in the construction industry. There's other ancillary. The mortgage business is certainly going to be hurt. But I think generally a lot of the stats that you've read this morning, I mean, let's remind ourselves we're at historic lows for foreclosure rates. I mean, the lowest any of us have seen in our lifetimes, and now we're going to come back to something that's more historically normal. Mm-hmm. We're normalizing, and so we kind of going through the process of normalizing. I agree with Joseph. I think that you're seeing a lot of the subprime product coming back. Foreclosure rates are, coming up 1,800%, but let's look at the stats. Your normal middle market buyer is still doing well. They're even, moving. They still have their job. If we were losing jobs, to your point, we would see, I think, a distinct different flavor. But I think we've kind of seen the shakeout of the frothiness that we had in the market going back 5 years.
And as Con House said, we did lose a lot of manufacturing jobs in the 90s, but we've seen the service sector pick up quite a bit, and that's still healthy in Los Angeles especially.
How widespread were these exotic mortgages? I mean, were banks like Wells Fargo and the major big lenders like Wells Fargo involved in some of these exotic loans? To what extent?
Well, it depends on what you define as an exotic mortgage. An exotic mortgage, according to the papers, would reference like a interest only, where you don't pay down on your principal balance. There was another one that's a negative amortizing and option arm, where you can pay the minimum payment interest only or fully indexed. And we did participate in the interest only market. We felt we did it correctly and responsibly. We had minimum guidelines for an individual to get into that product. We decided against the option arm, and we did not participate in that product.
And I'm sure you're happy now that you made that choice.
Yes. We felt that the way that that product was being originated, although it's good for certain individuals, that perhaps it was being sold to individuals that may not have understood it completely.
Well, when we talk about the subprime loans, I mean, how much of the mortgage market, how much of the business are we talking about? 10%, 80%? I mean, or somewhere in between?
From the statistics that I have seen and that I've been shown, the height of the market was around 20% of the market. And Wells Fargo believes in subprime lending, and we think when it's done responsibly, it clearly puts individuals into homes that would not have normally gotten into them under traditional underwriting guidelines. But as I said earlier, there appears to be individuals that didn't do it responsibly. And in some of the loans that Joseph referred to, that they really didn't verify that they had the ability to repay. They did it with little or nothing down, so they had nothing into the transaction. And those are the ones that seem to be coming back in the foreclosure market right now.
So the system was being stretched to the point where people who really shouldn't have had the loan were being given loans just to keep business going. Is that the idea?
But I think he did make a good point that by not having really harsh lending requirements, it allowed thousands and thousands of people to buy into a home in a market that has been appreciating, and that's so it made a lot of homeowners and got them a foot in the door to building the equity and building wealth. It's just I guess your argument would be it went too far with some lenders.
Yes, and the 20%, that's not a Wells Fargo percentage. Ours was dramatically under that because we felt that if to do it right and to verify their ability to repay, no stated income on individuals that had a lot of credit challenges and a lower FICO, we purposely said we are not going to participate in that market. And as it is with other products, we're very glad we didn't, and we're very proud of the responsible approach we took.
So 20% would be kind of an industry-wide figure then?
Yes, not with Wells Fargo.
But it's important to remember that 20% in 1 year is not 20% of the business and mortgage that a bank is doing. You know, some people are on year 29 of their mortgage. That's just 20% from the most recent years.
Mm-hmm. So what's being done now to tighten things up? I mean, to bring things back in line?
From a lender's perspective, there are certain segments of the subprime loans that we've originated that we've seen issues with. It's not that great, but so we're addressing those as to loan to values and cumulative loan to values. And so and on the prime side, we really haven't seen any strictness on underwriting the way that we've seen others change. But I think other lenders are just flat out getting out of a lot of products where it's 100% LTV, no money down to purchase a home, stated income. All those seem to be going away. Now that's something that we never participated in, but it's those kind of mortgages that we are seeing exit the marketplace.
I appreciate what you're saying, excuse me, and I just want to emphasize that you're saying that Wells Fargo really was not a participant in any major way in certainly in the more exotic and unusual loans that really stretch things to the limit. But I appreciate your explaining to us as a lender what was going on in the industry.
Yes, there were individuals that went out there and didn't verify the borrower's ability to pay. They went into it, as Joseph talked about, knowing that they had credit challenges and they were going to have delinquencies, and they got no buy-in. There was no down payment. It was 100% loan to value, and those are the ones that seem to be defaulting at a very high rate.
So in the process now of tightening up credit, are we now going back to a situation, Con, you referenced before the fact that with the looser credit, thousands of people who would not otherwise have been able to buy into the market were able to purchase homes. But now are we going back to a situation where people like that are being eliminated now and reducing the number of people who are eligible to buy homes?
Well, I hope that regulators find the right balance, because I think we shouldn't underestimate the importance of making it possible for people to be homeowners, particularly in California. Everyone's greatest asset is their home and their greatest appreciation in terms, it's been the best investment any middle-class family could make. And we'd hate to cut off that opportunity for people striving to enter the middle class. And so I think obviously there has to be some reform, but it shouldn't clamp down and cut against the goal of making it possible for Californians to be homeowners.
The real problem is why we have people buying houses that they can't afford is because we have so many missing rungs on the lower end of the housing ladder. And that's where affordable housing comes in.
Mm-hmm. I think you'll see some traditional sources of subprime sorts of loans, subprime in the positive sense, meaning as Con and Tom have gotten into, of getting those buyers who are just right at the edge of making it to a more normal mortgage product. FHA is a good example. You know, from what I've read, FHA as a traditional lending source kind of went out at the window as far as how much loan product they did, because there's so much subprime product out there and it was so aggressive that FHA kind of just was left in the dust. And that, you know, that's not a bad thing, it's not a good thing, it just is what it is. But in discussing with folks I know at HUD, they're saying they expect FHA to come back as a more normal source of the monies that a non-traditional buyer not able to qualify for that kind of middle market mortgage product. So that's going to come back a little bit. So there won't be, the regulation will kind of shake some of that out. I think we'll kind of uncover what we had before in that way. We completely agree as a developer. We want to see folks get into housing that they can afford appropriately. But they're, I mean, California has some of the least affordable markets in the entire nation. Having product, mortgage, housing that is appropriate to get those folks into housing, that's going to be part of the overall solution.
Well, I want to read you again some numbers here. Financial planners say people should spend no more than a third of their income on housing. By this measure, more than 50% of homes in LA were affordable in 1996, 11 years ago, to those earning the area's median income. 50% of homes. Today, 5%. And that's unbelievable.
And that's the problem. We don't have enough lower market housing on the market. We don't have any vehicle for which a first-time buyer or a starter home that we used to know them as, we don't have that type of housing coming on the market for some reason.
Why? Why not? What's
well,
wrong?
I think there's, the city is a great, here in Los Angeles, the city can be used like a bridle on the horse that is development. And the city has been leading the horse in a way that punishes it rather than in a way that makes it happy and runs it along. And we see things like the...
What do you mean? In what way does it punish? You're talking about the city punishes developers, you mean?
Well, sure.
By inhibiting what they want to do?
I think that it does, like on the west side where we see the condo conversion ordinance, and a moratorium on conversions. Well, this looks good to a renter because they'd like to stay in the place as long as they can, and we're all for that. But we need, in Los Angeles, we need more housing on the market, plain and simple. We have a disproportionately high number of renters to homeowners in Los Angeles. So how are we going to get those places? It seems like if there's a building ready to be converted, why don't we help that along? Instead, we punish the developer typically, or we punish the owner rather than help it along.
Well, I think we need to turn to our former planning director now. It's great to have you here.
Well, actually, it has been the city's policy to encourage supply. I mean, it's not going to solve all parts of the housing crisis, but one thing everyone agrees on is you have to build more housing. And one of the problems we're facing is that there was very little construction during the 90s. I think in the city of Los Angeles it dropped to 2,000 units. in the entire city.
And why was that? Because of the drop in the market?
Yes, and well, recession in general,
Yeah.
but with home prices dropping, it wasn't profitable for someone to build. Fortunately, in the last 4 or 5 years, there's been pretty high construction. In fact, it's gone up. I think a year ago it was about 11,000 units. And but the city has in the past, and I think it'll have to in the future, find opportunities to make it easier to put more supply on the market. One of the things that his firm is built under was the adaptive reuse ordinance, which allowed older buildings, commercial buildings, to be converted to apartments. And I think there's been 7,000 units in the last 5 years created in downtown Los Angeles just through conversion. And that was conversion that didn't displace anyone, because these were empty office buildings. So there are tools, but I absolutely agree with you that you got to have supply, and also the supply can't all be $1 million condos. It's got to be product that people earning a median income can begin to afford. And one of the problems is we used to build, after the war, if you look in Southern California, people built tens of thousands of homes that were 2-bedroom and 1 bath. No one builds that anymore. And I think even nationally we're finding that because of the rise in the cost of housing, the market, the buyers are willing to come down in size. And so, whereas they used to think, oh, they don't want to live in less than 2,000 square feet, they are finding you can have a terrific life and raise a family very, very well in a much smaller house or a condominium.
Well, Scott, you're the developer. Why does there always seem to be this tension, and not between you personally, but between the development community in general and the city, over how much low, moderate, affordable housing will be included in various projects?
You know, I was thinking as I was listening to the answers to some of your questions, I mean, none of us are forgetting here, but for the audience, I mean, California's been very politically conservative neighborhoods and cities regarding growth. Growth has traditionally, over the last decade or two, not been a good thing. And so what we saw was just general political resistance to development, to growth, and specifically to density in a lot of the communities that we've worked in. I'm seeing that change. Somewhat of a sea change, I guess I'd describe it, in cities that, certainly City of LA and other cities that are now recognizing a new trend, not a new trend, but they're newly recognizing this trend in the sense that now they understand that it's part of their job to supply housing or to help incentivize it. And there's still that resistance that Joseph talks about. But I think, and it's not consistent everywhere, and it's not even consistent within a particular city, but I think the politicians certainly are seeing now that constituents are starting to lose their kids or moving out of state because they can't afford to live in the community that they grew up with. San Pedro is a great example that parents have owned there for 20 years, kids can't afford to live there. But we still are operating under a traditional kind of no growth, slow growth sort of mentality generally, and we hope to just continue to see that improve and change over the time. We're certainly seeing a move towards more dense housing, to Khan's point of folks who are willing to live in smaller units that are transit oriented, that have amenities that are more urban. They want to be able to walk out of their unit and walk down the street and get a cup of coffee and ride the train to work, as Joseph did today. So we're seeing that change, but it's going to be a long haul. The
projects that you're working on, I think you mentioned one in San Pedro, which was in an old bank building, is that
Correct.
right? Yeah. And there's another, I think, large project that you're involved in the LA area.
That's correct.
Do these projects include housing, so-called affordable housing?
Well, interestingly enough, neither of our communities in the city of Los Angeles do, although both have the requirement under the Subdivision Act of setting aside under a covenant that if the housing authority wants to come buy those units later on, that they have the right to do that. But we had been developing these communities prior to the kind of formal inclusionary housing requirements. But there's certainly, that is one of the other trends that we're seeing from a political standpoint and city standpoint, that it's it's changing.
But aren't what you're building, it's already priced, though, at a point probably below the median home price.
And Colin's point is exactly right. I mean, because of the density, because of the adaptive reuse ordinance, it allows us to move more quickly into development, and we're able to basically provide a unit because of those things that is a more affordable price. That's, I think, why one of the reasons we're continuing to have good success in sales is because we're not in that $1 million range. If you look at projects that have that $800, $900 million price, those sales are suffering. But if you're at that, $400, $300, $500,000 range, there's still a lot of buyers. I call it kind of a middle market buyer, but they're working, they have the incomes, they can qualify for the mortgage, and they're still seeing the value of housing, and they can get into that housing. So that's, thank you for that. It's an important point.
The median home price in the county is now, what, $525,000?
Yeah, I know it's in the 500s.
So any product, any new product that can be brought in at less than that is really solving or helping solve the problem.
The median price in LA is now
County, I believe.
Oh, okay, yeah. This is let me see. This must be for California. 570,000. Now topped 570,000.
And I think in Orange County it's 625.
Yeah, that's right. Yeah. Well, I mean, it seems to me that we have a situation, and that we have for quite a while now, where people who are whose work is urgently important for the community, police, firefighters, teachers, are forced to, in order to find housing, to go so far out beyond, Lancaster, Palmdale, you name it, Ventura, Oxnard.
The term is called drive until you qualify.
Yeah. And considering the way the freeways work or don't work these days, I mean, you're really asking people to make quite a sacrifice to live and work here.
Well, regretfully, I think that we can lay some of the blame at the developers' feet, and I'm sorry to say that, but for years and years, they have been building. Developer wants to make money, and they've been building pricey units because that's what the market will bear. Even with the subprime loans, that's what the market is bearing. Now I think we're beginning to see a little bit of a comeback, and what you've described is a market solution, which I think is, and it's music to my ears. It's a good way to go. I think that the city has, in its anxiety to service the so-called workforce housing, has cultivated and developed all these ordinances and all this, spent a lot of energy that it could be using to actually incentivize the type of building that we want to have built. I know there's been, for years and years, a disconnect. You'd go to a trade show in architecture like Kaboom, we just had it this spring.
Yeah.
We have all these prefab solutions. We have the best architects in the United States here in the Southland, and none of it gets built anywhere in a municipality. How is that happening? We have micro housing available, we have great prefab solutions, but we don't see any of it being funded by banks. We don't see any of it being picked up by developers. We don't see anybody running with the ball. I am all for a market-based solution to the housing crisis, to supplement the missing rungs that we've had on the housing ladder. I hope it happens.
But first of all, the missing rungs are the starter levels,
Yes.
where people
Yes.
can get into the housing market for the first time, right?
Yes.
And I'm still not clear on if the technology is here, if the planning is here, why isn't it getting done? Why hasn't this been pursued? Why are these rungs missing on the housing ladder?
I think the big reason that a developer will tell you is land.
The cost of it.
Yeah, cost of land. If you have a $150,000 prefab house, you still got to put it on a $250,000 lot somewhere in the city. So that's a big problem. But also, I do think at the municipal level, especially here in Los Angeles, we devote too much energy to solving affordable housing politically. I think the market can solve it if the market is incentivized the right way.
What do you guys think about that? I mean, because you're all stakeholders in this.
Well, I do think that land is a critical element because the cost of materials, the cost of labor, the cost of capital, all of those are things that a municipality has, or even an individual developer can't affect very well. But the cost of land, if cities look for opportunities to convert land to not only residential use, but in some cases